I'll start with you. We were talking about this a couple of days ago, and we were discussing about the fact that these changes that were proposed are just incremental in nature. Now that these announcements have come, would you still hold that view?
I think, Harsha, a very important change which we must all make note of is in the area of capital gains taxation. Important from the point of view of what was proposed in the original direct tax code. If you remember, in the original direct tax code, what we were told is that capital gains will be taxed at the regular rates of income, so which would be the maximum rates applicable 30%. In the revised discussion paper, in pursuance of submissions made all around, what we were told is that long-term capital gains, if you did the math, effectively would be taxed between 10 to 15%. But there was no change in short-term capital gains tax rate, would be normal. Now, I think what we have got seems to be a pleasant surprise, and I talk a little bit about it because it's important. You see, the long-term capital gains, what we are told again, is the same as what we have today, which is exempt for listed securities and for equity mutual funds, which I think is a welcome move because it encourages long-term capital formation and investments in risk capital. Short-term, today we have 15% short-term capital gains on listed securities. Now we are told it will be 5, 10, 15% through a formula. The question I have from a policy standpoint, Harsha, is the rationale for bringing back a concessional rate of taxation on short-term gains. We just heard the Revenue Secretary dole out some numbers of the revenue sacrificed. And I link this up to the other proposal, which is a bit beguiling as well. Why do we now want 5% tax by way of DDT on dividends declared by equity mutual funds? Because those are the funds which, they are investing in the market, they are investing in long-term capital. And then you want to give concession on short-term gains. So I think if there was a revenue loss, I would have expected not to encourage short-term capital gains and, not to discourage dividend distribution. So that's a bit of a dampener. Otherwise, on an overall basis, capital gains tax is incremental vis-a-vis current provisions, quite substantial vis-a-vis what was proposed in the original DT. So it depends how you look at it.
All right, Gautam, before I get to Siddharth, let me bung in a quick question with you. The good news here is now we finally have a date as far as the direct tax code is concerned, albeit a delayed one, but April 2012. The finance minister has always expressed his desire to simultaneously roll out the direct tax code and the goods and services tax. So would it now be safe to assume that we are looking at an April 2012 rollout for the GST as well, on the back of what you've heard today?
A little difficult to speculate on the GST. Yes, the direct tax code is definitely April 2012, and that has two implications. One, obviously, it gives taxpayers an additional year to, reorganize their affairs or get prepared for what is coming. But also, I would think it would give the tax department and the tax authorities that much more time to, run this through their own team and educate the tax officers on the new code.
But what about the possibility of more changes? Because we heard the Revenue Secretary, he didn't quite directly say that, but he was perhaps alluding to the fact that when indeed this is going to go through Parliament, the Standing Committee and so on and so forth, we are perhaps going to see more changes. And remember, we are getting, as we head closer to elections, perhaps this could see more changes as well.
Well, they say this is the era of change, and if we've already seen 2 rounds, actually, this is the 3rd draft of the direct tax code. I would presume there would be another window for taxpayers to make representations, and that would probably be if the matter gets referred to a select parliamentary committee. We'll just have to wait and watch, and depending on the level of lobbying, let's see what finally comes out.
Bala of Infosys also joins in. Bala, many thanks for joining in this evening. What did you make of the changes that have been proposed in the Direct Taxes Code Bill? Corporate tax at 30%, MAT on book profits 20%. What did you make of it?
No, I think it was as expected because they've given away something on the personal taxation front. So they maintained the corporate tax at a 30%. MAT is today 18%, but including surcharge, it comes to close to 19.9%. So they made it 20%. So nothing earth-shattering in this new change.
right, nothing earth-shattering in the new change, but let me get all of you in as far as special economic zones were concerned, because as we had reported, there have been concessions that have been made for special economic zones, both for developers as well as units. Bala, your quick comments on SEZs before I get the two tax experts in.
No, I think on the SEZ front, they are given some breathing time, because they said if it is notified before 2012 and starts production by 2014, you will continue to get the tax benefit. So they're given more breathing space for people to come into the SEZ scheme. To that extent, I think it's a surprise one. So.
Well, Gautam, how would you react to the grandfathering that's happened on these special economic zones? This was, of course, a big bone of contention between the Finance Ministry and the Commerce Ministry, and finally the Commerce Ministry seems to have had its way.
Yeah, I think it's a welcome move, definitely, because of the fact that, people would have already gone out and at least committed to making investments, and then to retract from that position is rather difficult. So that's a welcome move.
Siddharth Zarabi joins us now. Siddharth, you were there with the Revenue Secretary. Any other key highlights that you would like to take us through in terms of what you seem to pick up, reading between the lines of what the Revenue Secretary had to say?
Well, clearly, 2-3 points that came across from the Revenue Secretary's press conference and subsequent interactions that me and my colleague Akanksha Sethi have had with CBDT officials. The first point really at this stage is that it is not yet clear whether this will go to a standing committee of finance, which is the statutory committee, or to a select committee. Nominal difference in terms of the time that will be taken to approve of this bill by Parliament. So that's point number one. Point number two, in response to a question about why 2012, I think our experts have also explained that, but the perspective from North Block really with regard to that is that adequate time needed to be provided, especially because a whole lot of subordinate legislation has to be rewritten, and therefore, while legislatively it was possible that the Finance Minister could have stood up next budget and said that this is coming into effect, I think the idea was let's not try and take a chance considering what has happened on the indirect tax front. And if I could quickly go to the indirect tax front, which is not related to this at all, but really at this stage, and I heard you ask this question, while DTC is coming in from 1st April 2012, the expectation as of half an hour back in North Block with regard to GST is that it can be introduced mid-financial year next year, because unlike direct taxes where advance taxes have to be paid from the first date, in indirect taxes that does not apply. So therefore the second leg of the tax reform being planned by the Finance Minister could possibly happen mid-financial year next year. One of the key milestones really at this point of time that we have picked up is that post that 1 month period that some states had sought and was granted by the Finance Ministry, a fresh meeting of the Empowered Committee will be called. So coming back to the direct tax front, there are a lot of provisions which Finance Ministry officials acknowledge will be asked for or requested for being rewritten, and therefore the entire rate structure and several of the proposals attached to it should not be taken as if they have been written in stone. There is adequate scope for these to change, and one quick final figure which will dictate any such changes. At this point of time, the corporate tax rate structure proposed in the DTC will result in a loss of around 53,000 crore for the exchequer in the first year of the DTC reduction. Now, given economic conditions and whatever is likely to happen, if this number is to go up or change otherwise, that will be the pressure point on which the tax rates will be changed. Otherwise, more or less, some stability has been granted, and it will obviously remain for the Finance Minister to decide whatever else he wants to do every budget. Back to you.
Well, the uncertainty on the rate is still there even after 2.5 years, Siddharth. I mean, well, we're talking about GST on another day. But Gautam, coming on another point that I wanted to raise was about, this taxation on mutual fund income. What do you think is the rationale of the government coming on this one? Is it sort of building that level playing field as far as investments in insurance and investments in mutual funds, sort of making the tax treatment on the same level?
There are two separate points over here. One is introduction of this 5% tax. And clearly, while, the rollback of the long-term capital gains exemption is definitely a positive move. Investors are used to receiving, tax-free returns, so to say, from investments in equities, either through the mutual fund route or through the insurance company route. So at the first instance, yes, there would be an additional tax a liability of 5%, not a very large number, but there would be a tax liability of investments through these routes. Second question is, yes, for the first time they have bought in life insurance companies and what they call equity-oriented schemes of life insurance companies as well, at par with mutual funds. Logic is obviously, from the tax authority's point of view, is to remove any arbitrage which investment products, as they see it, to be similar. There should be a similar tax regime for similar products out in the market. So that could be the tax authority's point of view on that. But I think a related point, if you just step back, would be, one has to see what impact this additional 5% leakage will have on the ability of mutual funds and life insurance companies to garner funds for collectively investing them to the stock markets. So very clearly, if an investor has to invest directly in the equities markets, he could get away without the 5% tax leakage. So I think this is a bit of an anomaly, and probably because an equity-oriented scheme is defined as at least 65% equity and possibly the potential to have 35% of non-equity. That could be the logic of having a 5% tax on returns which come in through such schemes.
Right, Sudhir, if I can come to you now, the criticism really has been that this is not as radical as, or in keeping with the philosophy of the direct tax code as it was actually envisaged. It's a much watered down version. You've already pointed out one or two anomalies that you have spotted already. But the rest of it along expected lines, especially if you look at the corporate tax rate and even MAT, they're on the higher side, but not really coming in as a surprise at 20%. Any other anomalies that you've spotted?
Well, I wouldn't say there are frankly, any anomalies per se. There are some, welcome reliefs. For instance, at least what I did not come across is any legislation dealing with controlled foreign corporations. If you remember, the CFC was talked about in the revised discussion paper. It seems to be conspicuous by its absence. What we were actually expecting is detailed legislation on what form and shape will CFC come. But we were also saying that India Inc., and Bala can comment on that, but it's too nascent a stage in terms of outbound investments to bring in a very complicated legislation like CFC. That revenues the government may have garnered would have been, it's a subject matter of debate whether we needed that complexity. Now that seemed to be done away with for the time being. That's at least my reading.
In fact, Sudhir, I've just got an email that's popped in on my computer, and in fact, that's talking about the CFC provisions. I understand that CFC has been defined as a foreign company, should not be listed on any stock exchange. Residents in India should have about 50% control of company. The minimum income should be greater than 1 crore, and it should not be engaged in any active trade or business. This has just hit my computer as of 30 seconds ago.
Right. So, and I think they are then going to provide for foreign tax credits as well, which was lacking in the original draft. Because what happens is, if you don't provide for a matching foreign tax credit on the taxes paid in the foreign country, we would have seen a humongous increase in the effective tax rate payable by Indian companies with investments outside of India. So I think that was one. The other is, if you ask me, there doesn't seem to be any let-up, if you like, in the all-pervasive general anti-avoidance rule, which has been written into this bill as well. It seems as exhaustive as the earlier one. The concern is that how do I, as a taxpayer, go about doing my business in a way that I will satisfy the tax man that this is the maximum possible tax I will end up paying, and there was no intention to evade tax. I think it's a very, very pervasive definition. What would have been better, in my view, is to define spatial anti-avoidance rules. Wherever you want to catch hold of, like sale and leaseback, we have seen in our own current code, was sought to be plugged in a particular manner, because that gives more certainty to the businessman to say, okay, these are the ones which will be frowned upon. Today, I don't know what will be frowned upon, what will be disregarded, what will be recharacterized. So there are a lot of those nuances which are not evidently, addressed in this bill. But barring that, if you ask me any lacunae or any loopholes, I think India could not have asked for, frankly, anything better than this.
Bala, do you have reasons to smile? Sudhir seems to suggest that there's absolutely no lacunae, no clarification, no concerns. Would you agree?
Yeah, I think the government has done whatever they can do, because the uncertainty on SEZ was too much because people have planned the investments and now they're given a lot of breathing space for those units to come out. So I think it is better than what many people expected.
All right.